Agent's role and ethical guidelines. The document states that an agent's main job is to recommend the most appropriate segregated fund or annuity investment for a client after completing their individual investor profile. For group recommendations, the process is addressed later in the manual. The Canadian Council of Insurance Regulators, CCIR, and the Canadian Insurance Services Regulatory Organizations, CISRO, have provided guidance to ensure the fair treatment of customers. This guidance for agents includes developing, marketing, and selling products that prioritize the client's interests over their own or the insurer's interests, providing clients with accurate, clear, and sufficient product information before, during, and after the sale so they can make informed decisions, minimizing the risk of making inappropriate sales, ensuring the advice is relevant, handling client claims, complaints, and disputes fairly and in a timely manner, protecting the privacy of client information, avoiding or managing any conflicts of interest that could affect the fair treatment of customers. The fair treatment of customers should be an agent's main objective, and their actions should support these principles. Making a recommendation. An agent's recommendation can be a single choice, a primary choice with secondary options, or several choices. Each recommendation has pros and cons, which must be disclosed to the client. Agents are expected by regulators and insurers to prepare a reason why letter that details the rationale for their recommendation. The agent must discuss the information in this letter with the client and record it in their notes to ensure the reasoning is available if questioned later. When making a recommendation for a segregated fund, the agent must consider a client's characteristics, such as wanting an investment with insurance benefits, a long-term time horizon, or the ability to bypass probate. The agent must analyze the fund's benefits and limitations and compare suitable funds. This involves staying current on new funds and developments through industry channels, journals, marketing materials, and product wholesalers. A fund's commission or trailing fees should have no bearing on the recommendation. Client suitability is the only standard. When presenting information, agents must be clear about what is fact-based and what is their personal opinion. They must also prioritize the features of a segregated fund that are most important to the client based on their investor profile. For example, if a client is most concerned about losing their capital, the agent should highlight the maturity guarantee. The recommendation is presented in a meeting, which has increasingly become a virtual or hybrid meeting since the COVID-19 pandemic. Agents must be prepared for potential technical issues or a client's lack of computer skills, which may require sending documents by courier and discussing them over the phone. Electronic signatures are now common and can be provided in several ways, including scanning a signed document, pasting a scanned signature, typing a name, or using a stylus or finger on a touchscreen. While convenient, e-signatures may make it difficult for an agent to detect signs of duress, fraud, or mental capacity issues, so they must be alert to any red flags. Segregated fund recommendation elements. A segregated fund recommendation should include fund identification and characteristics. The insurer and type of fund, e.g., equity, bond, should be identified, and the client should understand that they are investing in a pooled investment. Comparisons should be like to like, such as a balanced income fund to another balanced income fund. Deposit and funding. The client must state the amount they want to deposit, which must meet the fund's minimum. The premium is allocated to fund units at their net asset value, NAV, on the valuation day. The number of units received varies based on the NAV per unit and is not an indicator of fund quality or performance. Value of guarantees. The recommendation can specify a set of guarantees for both the maturity and death benefits, based on the client's risk tolerance. The maturity guarantee is automatically included in all contracts, typically at 75% or 100% of deposits at maturity. The investor receives the higher of the market value or the guaranteed amount at maturity. Withdrawals before maturity or surrendering the contract forfeits or adjusts the guarantee. The death benefit guarantee is also an automatic feature and can provide peace of mind to older clients or those in poor health. Contract maturity date. The minimum maturity date is 10 years from the deposit date. Some funds with 100% guarantees may require a 15-year maturity period. Principal risks. The contract's cover page warns that the investment is at the risk of the contract holder and may increase or decrease in value. Fund risk is diversified and classified on a scale from very low to high. The recommendation should consider the fund's risk assessment, associated risks, e.g., interest rate, market risk, and the client's risk tolerance. Reset feature. Some funds offer a reset feature that locks in increases in market value, often annually. Not all funds offer this, and those that do may have a higher management expense ratio, MER. A recommendation that includes a fund with a reset should show its effect on the maturity and death benefit guarantees. Contract riders. An agent must recommend whether to add an income rider, such as a guaranteed minimum withdrawal benefit, GMWB, or guaranteed lifetime withdrawal benefit, GLWB. Fund taxation. Taxation depends on whether the contract is registered or non-registered, and is determined by income tax legislation. Fund sales charge. The sales charge or load can be a front-end load, FEL, a deferred sales charge, DSC, or no load. An FEL is a one-time fee that reduces the investment amount. A DSC is a fee charged on each withdrawal and for premature surrender. Management expense ratio, MER. The MER is the percentage of expenses relative to the fund's average assets, and it reduces the return on investment. Fund performance is reported net of the MER. Fund details. The agent must explain the contents of the information folder and fund facts to the investor. Fund facts are mandatory to provide and are brief summaries that facilitate comparison between funds. Financial statements, which show a fund's financial performance for up to 5 years, can be requested by the client. Total value of fund. This figure, shown in the fund facts, is the amount invested in the fund and is relevant because a higher total value can potentially lead to a lower MER. Net asset value, NAV. The NAV per unit and number of units are shown in the fund facts and are used for comparison, but they are not an indication of investment quality. Date of inception. The date the fund began operations. Funds with longer histories have more reliable performance data and may be preferable for clients with lower risk tolerance. Performance data. This is always historical and should never be used to predict future returns. It is stated as an average return and year-by-year return. Fund manager. The fund manager is listed in the fund facts. An agent may consider the manager's tenure and track record when making a recommendation, as it can impact a fund's results. Portfolio turnover rate. This percentage indicates how much of a fund's holdings have been replaced. A high turnover rate can lead to higher expenses and, therefore, a higher MER, while a low turnover rate can improve investor returns. Fund penalties. The agent must point out potential penalties, such as account closing charges or short-term trading fees, but these should not be a basis for comparison or a recommendation to buy, as the agent should discourage early withdrawal or surrender. Annuity recommendations. An investor seeking income or a conservative, non-income-paying investment without the limitations of segregated funds may be a good candidate for an annuity. Just as with segregated funds, the agent must satisfy the principle of suitability by analyzing the benefits and limitations of a suitable annuity in light of the client's needs. The recommendation should be documented in a reason why letter and in the agent's notes. Annuity recommendation elements. An annuity recommendation should include type of annuity and characteristics. The two fundamental types are payout and accumulation. A payout annuity is for income and can be for a specific term or for life. An accumulation annuity is for an investment return approach with a suitable maturity date based on the client's time horizon. Timing of payments. Payments from a payout annuity can begin immediately or be deferred to a later date based on the client's needs. Annuity rate. The rate is fixed for the duration of the annuity. Agents who can shop around for rates can incorporate the best rates into their recommendations. Fixed income annuities are for investors with low risk tolerance who want income security. Variable income annuities are for investors with higher risk tolerance, as payments rise and fall with the market. Value of guarantees. Guarantees customize an annuity and can increase the cost while decreasing the payment amount. A guaranteed period for a life annuity minimizes risk by ensuring a payment to a beneficiary if the annuitant dies during that period. A longer guarantee period is for clients with a lower risk tolerance, but it results in lower payments to the annuitant. A return of premium rider pays the beneficiary the full deposit amount if the annuitant dies before the first payment. Principal risks. A key risk is that future interest rates may rise, making a set annuity rate less advantageous. This can be managed through laddering, where a series of annuities are acquired over several years. Inflation risk is also significant but can be managed with an indexed annuity, though this comes at a higher cost. Another risk is the lack of flexibility. An investor loses control of their capital in exchange for a secure income stream. Annuity penalties. The recommendation should highlight that an annuity is a long-term commitment and that some, like payout annuities, cannot be surrendered. Premature withdrawal or surrender should not be a basis for comparison, as both activities should be discouraged.